The gig economy stock Fiverr International is down 92% off its high. Now, you might think it's because of artificial intelligence and how it's going to impact the gig economy that has Fiverr International stock price down by that much. But I'm going to share with you why that's not the case. In fact, I'm going to share with you several reasons, including the company's revenue, profit growth, and the valuation, why it's an excellent bargain at current valuations. So let's take a look at this interesting undervalued cheap growth stock. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. So as I shared with you, Fiverr International is down over 92% off its high. But what you'll also notice is the bulk of the stock price drop happened in 2021 and early 2022. This was really before artificial intelligence and ChatGPT came onto the scene and really started to disrupt many areas of the gig economy. Even today, the gig economy hasn't been all that disrupted from artificial intelligence. It's really the perception and the potential of what could happen in the future to the gig economy from artificial intelligence. Now, I've made the case for several quarters now that I don't think the impacts are going to be as negative as have been forecasted. Now, I've been following the AI and the AI investing trend, and there are some companies that I highlighted that are absolutely going to get destroyed by artificial intelligence. And one of those, I think, is Chegg, the education technology company, the education technology stock. I think that one is going to be significantly hurt from AI and ChatGPT and large language models. Fiverr International and other gig economy companies like Upwork, I don't think that's going to be the case. I think there's going to be an offset where there are going to be some jobs, in fact, many jobs that are lost due to AI and large language models and agents, etc. But I think those are going to be offset by other jobs that are going to be created by people utilizing artificial intelligence to offer their services. And so on net, I think it's at least, or I think at worst, it's going to cause a single-digit percentage decrease for Fiverr International. Now, that's where I think is the downside scenario. The upside scenario is if it becomes a net positive where there's more people utilizing AI, offering more productive services at lower prices, which then attracts more purchasers of those services and creates this positive virtuous cycle for Fiverr International. Now, in the last 5 years, the company's revenue has grown nicely up to $372 million, up from a little under $100 million in 2019. Hiring people on Fiverr International, so much more convenient than hiring somebody full-time right off the bat. Businesses are turning more cautious when hiring employees because the process is becoming more complicated worldwide. Human resources and regulatory infractions really make it difficult for businesses to bring people on board, and the flexibility, right? Sometimes your business is doing really well, so you want to add more people, and then other times your business is not doing so well, so you want to let go of some people. But because it's so complicated to hire and fire people, that when you do it full time, it makes it more difficult to operate on those flexible levels. So businesses kind of keep this level employment, and they miss out on some opportunities when things are booming because they don't want to hire, because they know when things come down, it's going to be difficult to fire. But with the gig economy, with these platforms, businesses can expand and contract more flexibly, and so meet consumer demand more accurately. And that's a huge, huge tailwind for gig economy platforms. What's more, it's a lucrative business model. Fiverr International's operating profit margin has been growing significantly from negative 45% in 2019 up to negative 2.8% in the most recent trailing 12-month period. I like the platform business model where all the company does is bring together two sides of an equation. In this instance, it's bringing together people that are offering services with people that want to buy services, and Fiverr takes a fee for every transaction that happens on the platform. It's the essential asset-light business model, and I really like those business models. It's worked really well in many other industries, and I think it will work really well again here for the gig economy. Now, if you look at cash flow from operations to sales, which is more important than the operating profit margin for growth companies, because this signals if they are self-sustaining. If the cash flow from operations is positive, that means they're bringing in more money, more cash than is going out. And so they can sustain themselves, they can fund themselves. They don't need to go to investors and ask for money because they're generating money. There's a difference between cash flow and profit. Cash flow excludes some non-cash expenses like stock-based compensation and depreciation and amortization, which companies have to account for on their income statement, which sometimes leads to negative operating profits, but positive cash flow from operations, which is precisely what you see with Fiverr International. 25% in cash flow from operations to sales, but negative 2.8% in operating profit margin. The only difference here is non-cash expenses. But for a young company, for a growth company, this is more important because it means they can sustain themselves and continue to grow to scale where they can eventually reach profitability. They won't feel and they won't get at the end of their runway because investors say, all right, we're not giving you any more money because you haven't hit these milestones we want you to hit, and you're not generating sufficient return on capital, so we're not going to give you any more money. Well, if the business is self-funding, self-sustaining, they don't need investor money. They can just fund themselves through operations and retain earnings and continue growing until they reach a scale where they become profitable on the bottom line. Speaking of profits on the bottom line, for 2024, the analysts that are following Fiverr International stock expect the company will deliver $2.33 in earnings per share. So the next few quarters are going to be positive for Fiverr International in terms of earnings per share. Now, the difference between earnings per share and operating income for Fiverr International is interest income. The company has several hundred millions of dollars in cash where it can earn interest income. And right now, government bonds are yielding close to 4.5%. And so the company can generate significant interest income. Next year, the analysts on Wall Street expect Fiverr International will grow its earnings per share to $2.48. So a 15-cent year-over-year increase next year in 2025, or about 7% increase year-over-year. Now, that's expected on the back of a potentially slowing economy here at the end of 2024 and to begin 2025, as the unemployment rate is increasing, as consumer spending is slowing down, as credit card balances are rising, the economy is slowing down. And so next year is expected to be a slower growth year for Fiverr International. Longer term, however, Fiverr International will benefit from those tailwinds I highlighted earlier in the video, the convenience advantages of hiring gig economy workers instead of hiring full-time employees. And finally, Fiverr International stock is trading at a very cheap valuation. It's trading at a forward price to earnings of 9.516. It's trading at a single-digit forward price to earnings. This is the valuation companies trade for when they have essentially zero growth opportunities ahead. This is what tobacco companies are trading for, car companies, cell phone companies like Verizon and AT&T, mature markets where there is essentially zero growth expected. That's not the case with Fiverr International. They have a long-running tailwind. They have a lot of growth opportunities ahead over the next 5, 10, and 20 years. I've highlighted that next year, the analysts on Wall Street are expecting a roughly 7% increase in EPS, despite the slowing economy. So for this valuation for a company like Fiverr International, I think it's a bargain, even though there are risks with artificial intelligence, even though that could hurt the business longer term. Still, I think those risks with the potential reward are worthwhile for long-term investors to consider. Before I let you go, let me tell you about the greatest deal on YouTube. With just a click of a button, you can get free financial analysis from a professor with decades of investing experience. So what are you waiting for? Hit that subscribe button, and I'll see you again soon.